What were the unintended consequences of Dodd-Frank? Have you ever wondered how a law designed to protect consumers and stabilize the financial system could lead to unexpected challenges? The Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010, aimed to prevent another financial crisis. However, it brought about several unintended consequences that affected various parts of the financial system, particularly smaller banks, housing markets, and credit markets. One of the main issues arose from the extensive regulations imposed by Dodd-Frank. While these rules were intended to reduce risky behavior among large banks, they were applied broadly to many financial institutions, including smaller community banks. These smaller banks had not engaged in risky lending practices before the Great Recession, yet they faced the same stringent regulations. This one-size-fits-all approach increased operational costs for smaller banks. For instance, the law required more rigorous income verification for mortgage loans and mandated special training for loan officers. As a result, small mortgages became less profitable, discouraging smaller banks from offering them. This led to reduced credit availability for smaller borrowers and communities, contributing to a decline in the number of community banks that play a vital role in local economies. Additionally, the increased regulatory burden led to a rise in compliance costs. Many banks reported having to multiply their compliance staff several times over. This further squeezed profits and made it harder for smaller banks to survive. The result was consolidation in the banking industry, with fewer but larger banks dominating the market. With a reduction in the number of banks, there was less competition, which potentially meant less credit offered to certain sectors. Another unintended consequence involved the regulations on credit rating agencies. The heightened scrutiny increased the risk of rating downgrades, causing firms, especially those with lower credit ratings, to reduce their debt issuance and investments. This cautious behavior slowed economic activity in some areas, as firms were hesitant to take on new debt or expand operations due to fears of negative credit rating consequences. Moreover, the Federal Deposit Insurance Corporation was given new authority to manage the orderly liquidation of failing large financial firms. This created a specialized team that often had little to do in the absence of a crisis, highlighting the challenge of preparing for rare but severe financial events. In the context of financial history, Dodd-Frank represents a significant regulatory response to the 2008 financial crisis. While it aimed to increase stability and consumer protection, its broad application and complexity also illustrate how well-intentioned reforms can create new challenges, particularly for smaller institutions and certain market segments. The law's impact on the banking landscape, mortgage lending, and corporate finance reveals the delicate balance regulators must strike between safeguarding the system and maintaining efficient credit flows. These unintended consequences have sparked ongoing discussions about how to tailor financial regulations more precisely to institution size and risk profile. The goal is to avoid stifling smaller banks and credit markets while still protecting the broader economy.